Hey everyone, and welcome to An Operator's Blog. In this episode, we will be discussing engineering and navigating through an exit for your B2B SaaS startup. Joining me for this episode today is Madhu Chamarthi and Hans Kurdi, founders of HKMC. HKMC is a Silicon Valley-based advisory firm that supports both founders as well as emerging VC managers achieve their critical milestones on everything from fundraising, go-to-market, to even M&A exits. Each of them has more than 20 years of experience as deep operators in the Bay Area and has seen many exits in their career. So Hans's prior startups were acquired by PayPal and Google. Madhu's prior startup was acquired by Lightcast. So there's a lot of first-hand experience there in the trenches and pretty much from every side of the table. So I can't think of two people better than this to talk about this topic. So Madhu, Hans, really great to have you on this episode with us.
Thank you for having us, Mitra.
Thank you so much. I'm excited to be here.
Great. So let's get right down to it. So first question, and I'm just going to open it up to both of you. Walk us through the backstory of HKMC, how you guys came together. I mean, I know each of you individually as friends and you've had very storied careers, but how did this team up happen?
Well, see, I'll let Madhu say this because if it comes from me, Madhu will sound like a very stubborn, very keen observer of the markets and wanted me to sweat profusely before he jumped and joined me in doing this. But it was definitely much nicer and sweeter than that. Madhu and I have known each other 20 years, but I'll let him tell the story. He always tells it in a much nicer light.
Well, I will attempt to do justice like Hans does usually. So, I guess we've known each other close to 20 years now, and we've been in each other's lives as colleagues, as friends, as sort of brothers in arms, through a number of companies. And through the course of sort of the last 20 years, I've always spent time with companies, advising them, investing in them, helping them navigate their next stage, et cetera. And Hans actually saw the opportunity in taking the experience from Silicon Valley and then bringing it to a global startup audience way before I did. And he, was lecturing in entrepreneurship at UC Berkeley, and he kind of was getting pulled into guiding companies from all around the world, and said to me, maybe at this point about 3-4 years ago, hey, we should do this together. There's an opportunity in taking our battle scars and war stories and what to do, what not to do from Silicon Valley and take it globally. Why don't you come on board? And at the time I was running Beyond HQ, and I was sort of nodding because philosophically he and directionally he's always right, but I was sort of tied up with running my company. And when Beyond HQ finally found a home in 2023, the pitch from him intensified, and I thought, you know what, it's time now. And I cautiously dipped one toe in, and then I realized I was too slow. And now we're kind of going at 10,000 miles ahead, and continuing to scale HKMC. But it's really that kind of vision of how do we take the knowledge and the playbooks of Silicon Valley and bring it to the rest of the world. And two people have known each other so long, it's only natural for us to embark on a chapter together. And so that's what led me to join Hans in building out HKMC into what it is today.
And I'm really honored. I mean, having Madhu with his perspectives, his knowledge, his intellect, it added so much, and it really just propelled even what I was thinking about into all new avenues. So we are here from the combination of, Madhu's foresight and intelligence, and I think it's the sky's the limit. There's so much work to do globally, and we're obviously excited to be here and share some of that knowledge.
No, this is excellent, and I think especially in the context of the US-India corridor, which is where kind of I function as a venture investor, right? There is this massive theme of what I call as the global Indian founder, Indian founders stepping out, starting global companies. Of course, the Bay Area continues to be the center of gravity for tech, and I think both of you together bring so many years of having seen so many cycles in the Bay. And then second, a lot of cross-functional expertise and really filling in the gaps that these kind of seed stage, Series A, Series B founders, where operationally they are really good, but the Bay Area has its own way of working and its own kind of rules and playbooks, and we need more people to sort of provide that ammunition to these founders.
And I think the shared knowledge matters more than the individual knowledge. So of course, Madhu and I are greater together with our shared knowledge and our shared experience. And now with you, Sumitra, and the people that are listening to this, the shared knowledge is always so much stronger because there's always nuances, right? So everyone perhaps knows and understands the basics, but these nuances make one for great stories and two help people understand positioning better because we're in a fast moving market at times and the global shift is real, right? And there's a lot going on there. So it's really important to share as much as we can with one another.
Great. So let's go to the brass tacks now. So Madhu, I want to kind of start with you, right? So at least as an investor, and I would say post Chat GPT, I've been hearing this phrase, is SaaS dead, right? And of course, I've put this question to a lot of my podcast guests. In fact, I remember we recorded a podcast episode with Rajan Opekha, which is kind of one of the top US India corridor accelerators. But I want to hear from you guys because you actually spend a lot of time with large corporate, large strategic players, corp dev departments, right? It's a very different category of stakeholders. What do you think about this phrase? Is SaaS really dead? And what's this transition that we are in right now? What are these large companies thinking about it?
Personally, I am never a fan of absolute statements, right? Because they don't encompass the kind of the nuances and the gray that dominate the world. So if you look at SaaS as the kind of the environment where a software company presents a point solution that can be solving a single problem really well, then yes, that version of SaaS is dead. And arguably that was never really the truth. Even before the expansion of AI, tools start off as point solutions, then they become platforms, and then they scale. So SaaS is dead is a bit of a sensational statement, as I'm sure, Sumitra, you kind of think about, and all the folks listening here think about as well. In the context of AI, the way I'd like to think about it is static lines of code that have been static so far are now evolving into a dynamic, sort of increasingly agency-driven, sentient AI agents. So a piece of software traditionally did one thing, now it can learn to do many things. And that's a pretty profound reality to embrace if you're a company that's selling a B2B or B2C software, that wait, I can now write a piece of code that can grow to learn to do other things. I have to rethink everything, right? So from that perspective, it requires a very broad, very deep shift in the founder's mind to say, my product definition needs to change, how I innovate needs to change, my pricing model needs to change. So it's more of an evolution rather than this concept of this particular entire way of building software is dead. So that's sort of my theme, and I'm sure over the course of our conversation we'll get into the details. But my 2 cents to this point of SaaS is dead is it's evolving, it's expanding, and it is a exciting, probably slightly terrifying, but mostly exciting time for every entrepreneur, every team to think, how do I incorporate this idea of AI powered software into my company? So that's my sort of quick reaction here.
And I wholeheartedly agree. I mean, people who want to be that provocative, maybe they're attention grabbers and they just want to be able to say the next statement beyond the SaaS is dead. It's evolutionary. Things are changing. A lot of people don't necessarily know even at what pace, because every time we say by X year, we're going to have generative AI, and then it's like a year earlier and a year earlier. So things are changing and SaaS is changing, and it should. And we're here for it.
In my head, I always kind of frame it as it's almost like a continuum, right? And I always go back to there's a secular, almost like multi-decade movement of, I think what Mike Andreessen called software is eating the world. I think it just continues to eat the world. to me, I think, and especially from the context of the US India corridor, it actually started from the IT services wave
That's
that
right.
happened in the 90s, right? And then Y2K happened. And then, slowly as the internet came about, software products, so services became products. And then as cloud happened, products became SaaS. I remember when I was in venture, right? We used to call it software products in 2011, 12,
Mhm.
13, that time frame. And then 14 onwards, it actually eventually, like, slowly the word SaaS crept into things, and because of cloud and it's kind of cost going down and the ubiquity of cloud infrastructure. And now to me this almost seems like a next chapter. It's like another step up, right, with AI coming in, and with, so it's still, you're still building, and especially on the enterprise side, you're still building an enterprise software company. It's just that
Mhm.
the technology that is there at your disposal, and then of course with implications on pricing and business models, and then you can kind of peel the onion on every aspect of the business. It just keeps evolving. So I completely agree that it's actually an evolution.
Absolutely. And one thing I'll call out that's probably also distinct, and your point about implications, Sumitra, made me think about this, and Hans touched on the pace of change. That's probably the most profound shock that everybody needs to truly understand at a tactical operational level, right? The pace of change is so profound that whatever period you think you had historically over the last 5 years, 10 years to adapt to something just is kind of sort of gone out the window, in the sense that you now have to think about evolving, a little bit faster. And that little bit is a loaded phrase, because you see how quickly LLMs are evolving. Mercury is the industry's first diffusion-based LLM versus auto-regression-based LLM. So the pace at which it's able to generate code, their first product is Mercury, which is a code editor, is insane. And so diffusion was primarily used for images and for video. Now it's coming for text, right? And it's the same day 4.5 was launched. Last week, 3.7 Sonnet was launched. So you can, and then Hume AI launched their text to speech. And I'm sitting here going, if I'm a founder, or if I'm a CTO, if I'm a head of product, how do I keep pace with this, right? SaaS is dead really means the time period you have to truly comfortably respond to change is dead. Now you have to go much faster.
Yeah.
Totally. No, very well said. And coming to you, Hans, so in this new world, right? I mean, I remember in kind of the SaaS era, one of the key metrics that everyone thought about, including investors, acquirers, was ARR, right? So you kind of centered your thinking on the growth of ARR, what's the quantum, ACVs, churn, and all those kind of metrics. Now, in this day and age, and I know both of you are spending a lot of time with all the corp dev departments at the Ciscos of the world and the HubSpots of the world, what are the M&A acquirers looking for today in terms of potential acquisitions?
Yeah, they're going to be, I mean, pretty much what most people know. There's usually a handful of things that they look at, and it all depends. I mean, you're in a bullish market, bearish market, the verticals that we're in. But the handful of things that they look for, of course, initially is there a strategic fit? Are there synergies between the acquiring company and the acquired company, right? Does it help in the market expansion of the company? Is there an easy product integration between the two? And then is there customer overlap, right? So those those three that come to mind are basically around the first and foremost, let's make sure that there's an actual fit before we even start the conversation. Once you get into that, then of course you're going to look at the financials, right? Always important. It's important to look at, as you mentioned, the ARR, the general growth of the company. I think there are some pitfalls that happen where you're looking at revenue over profit. It's really important to make sure that profit is part of the conversation, not just revenue. And if the company's not necessarily profitable, is there a path to profitability? And what that looks like, and does that make sense from a general sense around the strategic operations of the company that match the acquiring company? Because as it gets absorbed, same operations are going to happen, in hopefully in both sides. And then what's the overall like retention metrics and expansion metrics, the NRR, like are those healthy? Does the math make sense? Always look at the math. And then that way you can kind of really truly see through the due diligence process how healthy that is. The other thing is technology and IP. Does the technology match what you're trying to absorb into your own platform? Is there strong enough IP? Sometimes IP, there's a shelf life of IP. So does that enhance or advance or increase the shelf life of current IP? I remember one company I worked for, one of the first companies I worked for was like a secondary market for non-core intellectual property, where there's a shelf life to most IP. The non-core IP can be sold or can be leased out. So one of the examples we used to do was IBM enhanced their or boosted their bottom line by $1 billion back in the day. This was a long time ago when I had hair, and and so that's a real thing. So when you're acquiring a company, IP still matters. Um, and then competitive positioning. Are you getting into a new market? Uh, is it better to acquire a company within this new market than building it your own or slowly penetrating a new market? It's really important to understand that uh, this company that you're acquiring, how well are they positioned within that market? Are they loved by their customers? Are they a market leader? Are they, second in command of that market? Is part of that acquisition going to boost you beyond that? And then, to round it up, I would say the founders, the current talent within the company, they're going to be absorbed into the company. You want to make sure there's somewhat of a cultural fit, but also a very strong team. And so it's kind of a double whammy. You're getting the product, you're getting the market, and you're getting some pretty awesome people along the way. That's a huge thing for companies to look for. And I guess the last thing would be kind of regulatory stuff. Is that are we in compliant? Do we need to be in compliance with something? Do we need to acquire a company to do that? Is there, risk assessment, all of that? That could also be part of why companies acquire other companies. And I would say that's kind of a general handful of things that people look at while they're thinking about acquiring a certain company. I'm sure there are more, but those are the basics.
If you look at specific acquirers, and I know that both of you spend a lot of time with the large big tech companies, right? And especially on the enterprise side, and Madhu, feel free to chime in on this as well. Do you see their corp dev departments when they're kind of talking to you about, hey, this is kind of our acquisition strategy, this is the kind of companies we're looking for, this is how we are kind of doing a market landscape or mapping the market out and filtering targets? Are there certain kind of common themes emerging from a lot of these corp dev departments, or are you actually seeing everyone kind of having very different stances, especially given AI and what kind of their respective competitive positions are and how their particular verticals or markets are? Uh,
Yeah.
yeah,
I mean, there's always like, is there a strong AI play in this particular thing? Can there
yeah.
be a strong AI play? Can it help boost profitability? Profitability is a big one, right? So as much as revenue is important, I think a Snowflake was used as example not too long ago with Warren Buffett around their profitability compared to their overall revenue. So the profitability is another big question, and they definitely double click on that and they make sure that the delta there makes sense for a possible acquisition. Um, and then it's the team, right? I think, sometimes we downplay that because we have enough of our people involved in this. We don't really need anyone else. But if you really do it right and you absorb the right team within that acquisition, the growth potential, and I think rejuvenating the founding team into doing what they've always wanted to do that they may have strayed away comes back in that moment, and then they're able to kind of double down on now with new resources to really increase the multipliers. So that's another point that I kind of just want to make in terms of some of the conversations, like, so who's running this? Who's behind this? And if we instill more life in this company, are they going to be able to go back to doing what they wanted to do? And how far away and why didn't they come to that level of growth that they wanted to, that this level of capital infusion makes sense this time around? So those questions definitely come around during these processes.
Absolutely. The team thing, I will say, to add to what Hans said, the team dynamic is probably safe to assume that is a common theme across any acquirer, right? Very rarely do you find, and it's not never, very rarely do you find acquisitions driven by technology alone or market presence alone. in the absence of any focus on team, because that's the team that brought the company there. So if the team isn't the right fit, then you are taking a huge risk in buying, even if it's awesome technology, if you ignore red flags about the team. To give you an example, Hans and I have experience with a company in the past, without naming names, we'll say there was a large, multi-billion-dollar company looking at acquiring one of the companies we were at early on. And they were looking at another company as well, similar to us, but slightly bigger. And that company probably would have costed this company 800 million. And they ended up choosing, they were ready to go forward with it. It's a much bigger, well-established player. It'll be, good. But the CEO or the founder didn't register that well with the buyers, who cared a lot about team. And then at the last minute, they're like, you know what, we're going to go with this other company. We like the founder. Yes, they're a little bit smaller. They still have some more things to prove, but I love the founder. So we're going to go with that. Right? That's crazy to walk away from a fit and then take on a company just because they like the CEO better. So that's one point. And in terms of teams, I will also say that usually it's rare for M&A teams alone to initiate acquisition idea. It's usually coming from a product owner or a business owner in the company saying, I like this company because I run the P&L for this department, or I run the product for this department, and those guys are doing something interesting. And that becomes the driver, and then the M&A team becomes the kind of execution expert, leading off of an internal request coming from the product team. It's rare for the M&A team to say, I have an interesting company, I'm going to go talk to them, and then I'm going to pitch this company into the buyer internally, into my sponsor who will like it, right? It's not never, but it's oftentimes the product. So a good tip I would propose is, if you find yourself working in close relationships with a business unit, then you have a much stronger chance at acquisition, because the business unit's going to say, hey, guys, we should really look at M&A for this company. So that's another theme, right? And then if it's on the private equity side, I know we'll talk about this later on, I'm sure. Private equity firms look for slightly different things. Maybe there's a slight, not to say that they won't emphasize team, they will too, but they're a little bit more mathematical, because they have a playbook. They have an aggressive kind of buy the company, split it up for parts, and integrate it into my other broader portfolio play. So that is valuable. But if you're looking at a traditional company acquisition process, think of the product owner, think of the business owner, try to build a relationship there. M&A teams oftentimes tend to be supporting the execution. And then they definitely look at all the flags or all the drivers that Hans mentioned.
And Madhu, I think kind of just double clicking on that point of private equity, right? If I kind of look back to even like 10 years back, as investors, when we were thinking about potential liquidity opportunities or who's going to give us an exit, you typically not think about PE funds. I mean, the multiples were not good. They were kind of not their track acquirers. You always wanted to sell the company to a Google or a Salesforce. But now I'm seeing kind of a renewed narrative, especially I think post 2021, where there are a lot of large private equity funds, lot of dry powder. The bar to go public, especially in the US, has gone up a lot. So any views on how should founders think about kind of private equity as a potential exit option for their SaaS startups?
Yeah, excellent question. And Hans and I are in the thick of a number of conversations with both the buy side and the sell side when it comes to tech startups and private equity firms, right? So we depending on how much time you give us, Sumitra, we can keep going forever. So there's two categories of private equity for the purpose of this conversation. Let's divide it into lower mid-market private equity, right? And then the traditional, you're at $100 million and above revenue range. So sub 20 million, 20 to 50, and then 50 to 100 and above. There's been for a number of reasons, there's been a renewed interest, like you mentioned. And it's not just the traditional big players, right? Not just the KKRs and the Carlyles of the world. you've got TPG, you've got Vista, you've got Thoma Bravo. They've all built excellent playbooks recognizing the growth potential of software as a space. And that has spawned lower middle market private equity, which is a company that's 5, 10, 15, 20 million in revenue. What can we do with that company? And there's so many specialized firms that have popped up that arguably implement quite a different playbook than the traditional private equity firms, right? They're not coming in and looking at, they don't have scale to work with, especially if you're a 5 million, 10 million revenue company. There's still some true founder operator support you need to give this company to make any reasonable financial exit. So you cannot come in and think about it as if you're buying a $100 million revenue company. So there's a whole host of guidance for the founder to consider that path. And there's a whole host of guidance for a PE firm looking at tech-based startups that are not at the super scale range to try and truly derive value from this. So lots of options. I heavily recommend folks, even if they're not in the market for selling their company, to just educate themselves on the opportunities for liquidity when it comes to private equity.
Yeah, no, this is super helpful because I don't think there's enough conversation right now about kind of private equity as kind of an exit method, right? So I think this is incredibly helpful. I want to run through a scenario that I see a lot amongst founders that I've met over the years, right? Where there's a founder building the SaaS startup, still in the early stages, doing something interesting, maybe doing something differentiated, and they start getting inbounds, right, from all these corp dev departments saying that, hey, we like what you're doing, or we got to know about you this, whatever. They got covered in some newsletter or maybe like even a Gartner report or something. The founder is obviously not in the frame of mind of kind of trying to sell the company, but then the corp dev wants to kind of quote unquote build a relationship. How should founders think about fielding these kind of requests, right? Because it is a time commitment, right? Engaging. And sometimes, there could be kind of competitive intel angles as well in all of these discussions. What would be your advice to founders?
Hans and I were just talking about it earlier. I'll start with a cheeky answer first, and then I'll go with a slightly more sort of well represented response. The cheeky answer is, especially if you're an early stage company, right? Ignore all inbounds. Just keep working on building your product to a point where you feel like, okay, it makes sense to me why these guys are coming. So that's my semi-controversial advice. It is very tempting from a ego standpoint to say, oh my gosh, like the head of BD at I don't know, Cisco is reaching out to me, or head of BD at Constellation Software is reaching out to me, and I should absolutely take a call and just kind of get to know them and build. It's a natural inclination, right? But again, oftentimes it is valuable to run this exercise even before you have anybody reaching out to see, why would somebody want to reach out to me and me as in my company, and put them to the test. One thing that Hans and I always joke about is, in VC as well, this applies, is see how you can verify the validity of their interest before you dive in and start talking about your business. One quick way to do it is seek some kind of insight or support from them, especially if it's a company that you've been wanting to connect with, or if you feel like generally, of course, it makes sense to talk to somebody at Google. So propose something that actually helps them demonstrate to you that they're serious in their interest. Hey, I've been trying to connect with this product team at your company, or I would like to connect with the product team at this company. It's a natural fit. Thank you for reaching out. Would you actually be open to giving me an introduction? And then we can have a conversation. It's a great time for you to reach out. Thank you, but this is what I'd like. And if the person disappears and says, no, I can't do anything, then that indicates that they're probably not that serious, or they probably don't have the pull that they represent or they're trying to represent.
Or they're trying to just deepen their information on the company, and they're trying to do some sort of, their own due diligence, and kind of like, when you think about it, these folks who are calling you, they'll have think of it a bookshelf, and instead of bookshelf, it's just dossiers on companies, like which company is going to be valuable at some point and whatever. Be a little bit selfish. Just say, like, so what's your interest? Why are you interested in us, and why now? And what is it that you know about us that
Yes.
enticed you to give us a call? And then, of course, there are the things that you can speak about, right? And the one that you want, use it as a marketing tool. Like, this is great to enhance the visibility of your company in the way that, and then use that in conversations. Like, yeah, we're getting calls for potential acquisitions. We really don't want to do it right now. We think the market is fantastic for our growth, and we're planning on hitting certain markers. And of course, no one is ever opposed to being acquired, but they're opposed to being acquired at a certain price point. Everyone's got their number, right? So yeah, it's actually a good thing. You just use it without having it slow down your momentum of what it is you're
Bingo.
doing.
Yeah, I couldn't have said that better. So the one other thing I'll say as an example of what I fielded, right, is companies, a younger Madhu from maybe years ago would get these calls, get these emails, and some of them turned out to be good relationships that helped out, ended up being helpful later. But as an example, a PE firm would call and say, or a holdco would call and say, I'm really interested. I did some research on your company, and they give you good points of research, right? And you get on the call, say, oh, great, you clearly researched about the company. I'll talk about it. And they'll ask you questions about what you're doing, et cetera. And you've given them a nice picture. Maybe you didn't spill your trade secrets, but you've given them enough that they wouldn't get from the web. And then at the end, what one of the people said, actually, that's good to know, that's great, but we're only looking at companies that are sort of whatever at an ARR that's much higher than where we were as a year-old company. So here you are, you gave everything you wanted to with the company, and then at the end he drops the qualifier, and you're like, why did we even talk? Then you knew we were not there because we're only a year old. So these are the things, and Hans's point of, let me ask you 7 questions as to why you reached out. Answer me these 7 questions in email before I turn around and give you 10 minutes of my time, even 5 minutes of my time. This is not to say, be antagonistic to them, right? There is value of your time, and they're in the business of seeking information from you, and you're in the business of protecting your time and only giving it to people that actually are valuable for you.
Because think about it, you're going to give them information, and they're going to give you a score, their internal score. They're not probably going to share that with you, right? So just understand that.
I want to also run 2 very, again, practical scenarios that I see a lot as a VC. And Hans, I'll kind of start with you, right? So a lot of founders, raise a little bit of capital, are building their SaaS startup, not really found PMF, it's kind of pushing a boulder up the hill, spent a few years, maybe got to somewhere like low single digit million ARR, but that too with like not very strong PMF, really no growth in the business. The founder is like, look, I don't see a future for this company, but you have raised money from investors, or you have investors, VCs on the cap table. So there is a responsibility to create an exit for everyone, right? And so I see so many SaaS founders in this situation. They want to create some sort of a salvage exit, right? So it could be an acqui-hire, maybe investors get some sense on the dollar back. And this is kind of very uncharted territory for most founders, right? Because they're obviously experts in their own domain and in building products, but not in doing these kind of deals. So what can founders do when they're sort of in this kind of a scenario to create such an exit, an acqui-hire exit, or some sort of a salvage exit, maybe even an asset sale?
Yeah, no, I mean, and you mentioned some of the ways that they can exit out. It's actually really important for founders to educate themselves in the M&A market probably sooner than later, just so they can understand that, okay, if my runway is ending at a certain point, they can actually start they've built value. So they have value, whether it's an acqui-hire or their assets, et cetera, that they can actually, instead of going to a VC and asking for money, they can go to a PE and say, we've got some pretty interesting, we're in a pretty interesting situation that might be of interest to you. We're in the low million ARR. We're a bit stagnant, and here's the reasons why we're stagnant. PE firms would probably understand that and know that they can use that value to enhance something in one of their verticals, right? So that's the thing. So if it is some sort of an exit you're looking for, just be proactive and speak well to your company. It doesn't matter what situation that you're in. Don't crawl your way to knocking on the door. They'll see that. Obviously, it's not necessary. They'll know where you are, but still show excitement in what you're doing. That's always really, really important. So it's not a distress sale. It's a, new avenue for the company that has value that can be added somewhere else, right? So look for the right buyers, right? And so not everyone's going to be interested. But is it another mid-sized SaaS company? So that could be a nice acquisition from them. Could be a competitor. Could be private equity, like we talked about. It could be one of your customers. So Madhu mentioned this, right? So it could be one of your customers that could find interest in what you're doing. And then so they could infuse capital within your company, maybe not, like a typical round, but a couple $1 million. You're now added into the company. Now you're a product or an add-on, a product to their platform one way or another. So, so stay malleable in your thinking around that. And then the just say this is a strategic play. We're going into this new situation. We have strong IP. We've got strong tech. We've got a strong customer base. Our team is fantastic. So again, you have assets. You have value. Speak to that value, and I think that's very, very important. And then I think at some point, founders will know where the fork in the road goes, and like, we really need money, or we're going to close down, or we need to figure out another avenue for this company outside of fundraising, through this form of exit and potential acquisition. So knock on the doors. Just as much as you put enough energy and effort around investor relations, this is the same form of relations where you're talking to potential customers around, hey, what do you think of our product? What do you think of our team? Do you think this is something we're looking for, an avenue of exit here early on? Obviously, it's going to be at a discounted rate, tremendous discounted rate. So you're going to know which customers you're going to go to or not. Back to my initial point, like, know who the buyer would be. And then, if you are at a high enough ARR, and Madhu always, hounds on this, like, uh, talk to a boutique investment banker, right? Who are able to help you. Maybe obviously not the large ones, but there will be ones that are going to be able to kind of help you position yourself in such a way where this is not a bad, like, yeah, you have strong enough assets. We can talk to some of our network to see if there's interest, et cetera, et cetera. So I would say initially just get the education, know that M&A, as an opportunity for early stage companies is an avenue that Sumitra, to your point, isn't really talked to enough. And so everyone's going to that same routine of, we need funding, we need funding. This is a bridge round, this is this, that, and the other. Like, nah, you can be out, go start something else. The market is moving quickly, and whether it's an asset sale, stock sale, et cetera, like, there are tools for you to use early on. So those are my main points. And if you start that route, know that it's like a 4 to 6 month process, could be longer depending on where you are and how sophisticated the operations are. And if your data room is fairly clean, and there are no major issues during the due diligence, yeah, that could happen. So within 6 months to a year, if you know the route of fundraising is not going to happen, look at M&A and look at these opportunities.
And I'll probably touch on something that equally, I believe, isn't addressed. And Hans, you made a point about educating the founder, educating themselves on these opportunities. I'll probably take it a step further and say, if you're starting a company today, arguably, if you started a company maybe even a year ago, one of your responsibilities to yourself and to your company is to be very aware of what paths to liquidity look like on day zero. Have that in your mind. The Valley, sort of for a variety of reasons, good or bad, has glamorized raising capital above everything else, and unicorn exits above everything else. Understandably so, but not without some difficult repercussions, especially when capital markets are not great and interest rates are not great, right? So if
Madhu,
I am giving it,
you can't say there's no plan B unless you succeed, right? Otherwise, we all know
right,
what that really means, right?
that's right. And it is imperative for every founder today to educate themselves on paths to liquidity in a variety of scenarios. So that's one thing I'll say. The flip side of the coin that people also don't talk about is, this is probably a little bit sort of psychology and that realm of things, is you are not your company. Okay. Nobody, you first and foremost should not judge yourself on the success or failure of your company. if you can healthily detach, look, this is an endeavor, this is a chapter in my life that I am building with my team and with my investors, then it actually positions you much better in looking at that entity as an asset and how creative can I get in finding a home for one of the entire of the asset or parts of the asset, right? The moment you think I am my company, then there's an emotional component. Then you are feeling a sense of failure, desperation, judgment. All of those are going to prevent your creative faculties in trying to find the right path. So you are not your company. You are building a company. You're a big pie chart, and a company is a piece of your pie chart in life. It may not seem obvious, but I hope at least some of the listeners recognize that that is actually a very important and healthy way to think about your company. Not only that, it's also a very valuable way to look, because now you have a healthy detachment and you can say, what can I do with this thing I built versus what should I do with myself? Which is a horrible, unfortunate, unnecessary implication when you're building a company. Those are two things I wanted to add to what Hans is saying.
Yeah, no, very well said. A couple of points on this from my side. I think one, I recorded an episode with Satya Gunny, who's the CEO of Beamer. So Satya has sold 5 companies in 15 years.
Yeah,
That's
So,
it.
amazing.
Oh,
so
he's
clear.
slacking. What's going on here?
So clearly, there is a method here, right? Like there is a process at play. There's a framework at play here, right? So it's not that it's not doable. That you can intelligently create liquidity and exit options. So that was one. And then second was I also encourage founders to really lean on the VCs on their cap table, because VCs oftentimes have very large portfolios across multiple funds. For them, it is it's much more easier to kind of merge portfolio companies together or even do acqui-hire situations. And typically, a lot of times, the board member can be common as well. And I think the onus is also on the VCs to make sure, because, also the founder, you want the founder to be still in the game, right? But you also want to back the next company. So it's in actually everyone's interest that, you get a win out of this.
That's a great point to call out. Your investors and your advisors, hopefully you pick them well, and they will happily work with you if you are open and upfront and wanting to collaborate with them versus being driven by fear, right? There's a lot of folks that were invaluable to me at the most recent company. I'll sort of shout out to Costa Noa Ventures, Ross Fubini at XYZ, Russ Fraden, who I'm starting to work with again, and a number of others, right? So they could make a difference between I don't see a light and oh my God, there's 10 other options that. By the way, not to mention, for me, Hans, before I was part of HKMC, was a source of that, right? Hans always. I'll speak about him not as my partner at HKMC, but a friend and a well-wisher in my prior journey. He was sort of like an informal advisor who always said, you have nothing to be worried about whenever I had stressful inflection points. And I couldn't see them as powerfully as he was presenting them because I thought I was my company. If the company has a downturn, I have a downturn. Like, no, that's not necessary. Right? So to your point, your advisors, your investors are a huge source. And I'm sure for the folks that are lucky enough to partner with you, I hope they're listening to this and saying, "Oh yeah, I need to call Sumitra more often."
Yeah. Though the psychology is so important in these things.
It is.
Moving on to the next scenario, Madhu, I think so. I want to kind of take up the classic M&A scenario, right? So founder has been 5, 7, 8 years in, probably raised a few rounds of capital. There is a business, it's growing anywhere from 10, 20 million ARR to even up to 100 plus million ARR. So a classic scenario, there is a liquidity window coming up because investors need to exit, employees are getting restless, you need to provide liquidity to a bunch of stakeholders, maybe including even for yourself. But let's say 24 months before, what can this founder do, right? To start, and this is where the engineering and exit part starts coming in, right? How do you
That's right.
even start? And most of these founders are not from financial backgrounds. They're not ex-bankers. These are not ex-M&A folks or McKinsey guys, right? I mean, these are all engineers or product people in most cases, right? So they have no idea. They're not deal folks, right? So what can they start doing even 2, 3 years in advance of creating a potential kind of exit outcome?
I'll piggyback on what Hans said. Right, a lot of the levers that Hans mentioned, which is and you mentioned, Sumitra, your advisors, your investors come into play, right? Customers are a segment that is often underlooked. Your customers can be amazing sources of potential liquidity because, well, who knows you better than your customer, right? But arguably, not even your investors sometimes. So there's a broader set of options available to you now because you're, let's say, 9 million in revenue versus 2 million in revenue. So the traditional options aside, which is you look at a PE firm or you look at a potential acquirer as a large Fortune 500 company or a public company, what have you. Beyond that, you're in a very fortunate position if you are growing well and you've got 24 months to make this call, right? It's a really good. So first, take a moment to recognize that it's a wonderful place to be. And then first and foremost would be what we just talked about, which is education. Before you even initiate anything, spend some time thinking, I and my team and my investors together built this amazing asset. What is the best scenario planning exercise I can engage in right now? Because I don't need to sell today. I don't need to sell 6 months from now. I don't need to sell a year from now. What are the paths? Which will allow you to look at customers, other buyers, PE firms, et cetera. So that's one exercise, is educate yourself on it. And a good banker and a good lawyer will make the difference between no deal and a deal, golden handcuffs or not. It'll make a difference between, selling it for 50 million less or 50 million more. So non-trivial numbers if you have good partners. Because they've seen, a good lawyer would see a lot of transactions and immediately call out who you should look at, who should not look at. A good banker would do the same. And many times there's a heavy overlap, like a good lawyer will introduce you to a good banker, right? And vice versa. And a good investor will introduce you to a good lawyer who will then introduce you to a good banker. So power of the community. The other thing I will suggest that's probably not actively discussed, in my opinion, is in today's world, with the ability to produce software and build businesses with AI, there's a huge wave of, can we just build this all ourselves? Permeating enterprises, permeating companies, right? So how do you think about presenting your value when the buyer, who is the average corp dev person at the average Fortune 500 company, is thinking, maybe we should just like build this. So it's a moment of flux. It's a moment of time that should make you want to think a little bit harder on, if I'm looking at 2 years from now, will my value of this 9 million in revenue and 70% year over year, 80% year over year, 120% year over year, whatever your numbers are, or 50% year over year, will this be still relevant as an attractive opportunity 2 years from now? And never before in the past couple of decades has it been more difficult to predict your value in the market than it is now. 2 years from now, who knows? If the model, LLM models and the code dev tools and all that stuff continues, your guess is as good as mine in how valuable my company is in 2 years. So how do you think about that, right? I don't have an answer to present on this podcast. What I do propose is founders looking at a $9 million business or $12 million business today with a 24-month goal of selling really need to think hard about how can they ensure against obsolescence in 24 months. And that's probably sounding hyperbolic, but it isn't. You want to really think, if I were to sell in 2 years, am I selling the current version of the business, or am I selling a version of the business that I'm going to build because of the AI advancements that doesn't even exist yet in my company? And that's what I should be pitching to a buyer and saying, hey, Google, or hey, a company that's 100 million in revenue, I'm going to pitch you a vision of my company that doesn't exist today, but we are the best ones to build that in the next 24 months. And I want you to be ready for that in 24 months. So it's a bit of a creative muscle flexing, but it's very imperative to think about it now, right? Because it's quite likely the case that the market's not going to look like this than it did So 2025 and 2027 is a bigger delta than 2020 and 2022 or 2015 and 2017.
No, very well said. I think typically in this kind of scenario, just to add to I think what Madhu you said, what I've seen in the past is in most successful M&A deals, the acquirer is most likely either a customer or
That's right.
some sort of a strategic partner, which
Mhm.
means there is enough familiarity between the
That's
people
right.
involved, the sponsors and the founder, also the organizations. And so I think creating that buy-in becomes so much easier. So once you start thinking about if you have to create an exit and you're starting to have that conversation with your VCs that, hey, we'll kind of need to create an exit 24 months, 36 months down the road, you actually have enough time to start
Mhm.
now thinking about all this entire landscape of relationships that are there around your business and start thinking about them in a more strategic way. Maybe that means flying out and kind of wining and dining with certain executives at these companies, building those relationships, seeing who's that
Yes.
person who's personally vested or excited about your, or maybe you have been dealing with like more junior operators in some of these companies. How do you up level your relationship? How do you get in front of, how do you get that exec visibility? Because ultimately it's the exec sponsors who are going to drive a deal, right? So
Mhm.
really thinking about, and these are fairly, I would say they are much more straightforward to do because, you already know these people and these companies.
I'm going to give an example about you and your last company. You're out there talking to a potential customer, spoke to the product so well, and the product spoke to their problem so well that right then and there, it was like, why don't we just buy you instead of, using you as a product here? So that's doable, right? So you start looking at at potential great way to look at your customers, current customers as potential acquirers, if the match is right, for sure. Yeah.
That's right. It took Cox acquired Adify in 2008. Cox was starting the conversation with Adify as a customer, and it took 16 months to decide. And turns out that they weren't really taking 16 months to decide whether to be a customer. They were diligencing us in that 16 months, right? So that's a great point. And I will repeat a phrase, Sumitra, that you said, which is the landscape of relationships. That's an excellent way to picture everybody around you and start nurturing and refining and diving deeper into every aspect of the landscape.
And it is a
No.
relationship game. People will remember the bad that you did, right? You can keep doing as good as you want, and just, if your relationship building skills aren't that great, people will remember that.
Great. I think we have spent a lot of time on the engineering and exit side. Now let's go to the navigating side, which is let's talk about aspects of the deal,
Mm.
right? So I want to start with the most important thing, which is what kind of is the center of any deal, which is valuation. So Hans, I think coming to you, uh, again, I think for most founders, they're not valuation experts, right? Yeah, I mean, once you raise venture rounds, you kind of learn a little bit about, how kind of people think about it. Let's say a founder's gone through the experience, like an acquirer has reached out, they're kind of in the process, and they're now kind of starting to think about valuation, whether does the deal make sense? How should they think about how acquirers will value their companies, right? Because
Yeah.
that also drives a lot of thinking in terms of timing, in terms of, hey, is this the right time or not? What is everyone getting out of the deal, right?
That's a great question. And I think first time entrepreneurs run into the mistake of overvaluing. They think it's the right thing to do or the better thing to do. But I think there's now enough knowledge, collective knowledge, to look at what the multipliers should be for certain evaluation or for certain valuation for the company. And that's, again, part of this continued education for the founders, for their vertical, for their business, for their market, to figure that out. But for, the revenue multiple is common for most SaaS and growth companies, right? So it's like for high growth, 30 to 40% growth year over year, you're hitting I don't know, like a 6 to 10, 15x ARR for that. And then for the subscale, the ones that aren't really growing, sub 5 million ARR, 1 to 3 x multiplier for ARR, right? Um, so it all depends. It depends where you are. And um, I mean, there is math to this, and you can figure out the math, but the math isn't the say all end all. You have to look at the market and see what the market is like. And then sometimes you can look, if you're looking at to be acquired, sometimes the buyer is going to tell you, like, sure, like, I'm so interested in your company, I'm so interested in your product, I want you now, I want you yesterday. So of course that could increase the multiplier a bit. For larger, more mature companies, it tends to be more on the profit EBITDA multiples. And I'm probably not going to go into that, but the math is there, and you could figure out that out. But I think where it also hits, like, if you're a new AI company and everybody's a new AI company and there's really no revenue, and or for deep tech or whatnot, it's like 1 to 3 x multiplier, because it's not tried and true. And then the valuations around your IP, your assets, right? Like your technology, and that becomes kind of a, straight negotiation from, the founders themselves. So I would say the biggest thing is don't overvalue yourself. Look at the market, look at comparables, and kind of see where you are and see how much money you're planning on raising, to kind of undervalue and over deliver, always probably the best thing. There are certain market types where the market is low on cash, but you're raise as much money as possible at whatever valuation you can get at the time, and then continue to prove out your concept, knowing that you can actually do that. Last thing you want to do is again, the overpromise, underdeliver. And what actually truly affects your valuation, your growth rate, your predictability of growth rate, looking at your NRR, looking at your sales pipeline, looking at the market itself. Obviously, there are certain things that we can't predict, but being able to predict in your market what you're in the books for this year, in the books for next year, and hitting those and showing that you've been hitting those the last year and the year before, always fantastic. And then, back to the buyer appetite, like, if it's high, if it's there, it'll impact your valuation, but also who's buying you, right? So we've talked about strategic buyers and financial buyers. Strategic meaning like other companies, larger companies, Amazon, Google, et cetera, buying you. They're willing to pay a higher multiplier for your company because it's going to fit their needs, their strategies more immediately. And then the financial buyers, lower multipliers. They can buy and park, right? It's not necessarily a necessity. It's not a massive need, but it's a nice value add to their portfolio. So that also is going to play a role in terms of your multipliers. And then, Madhu mentioned this, the team is always going to be important in terms of the valuation. You're going to have, multi startup founders. They're going to, you're going to be valued more. You're going to have more domain expertise along the way. And that's huge too. The one thing I want to mention is, and I think, I kind of mentioned, but like the issues when you're thinking about valuation and people just kind of get into it and they kind of lose their mind a little bit. You're focusing on revenue and not profitability, and that's not a good thing because in a due diligence format, that's going to be uncovered. You're ignoring some of the churn that's happening within your company because you're thinking that you're going to bring in, more business, and you got to look at these things, and you never want to overvalue your business, because that's definitely shooting yourself in the foot. And are you going to be competitive next year? Are there new entrants in the market? Is your competitive positioning changing year after year because you're fairly slow at, applying artificial intelligence, let's say, to your solution? So these are the things that you're going to have to constantly think about, when in that format.
And then I think one kind of follow up on that, which is a point of personal curiosity for me, is how do these acquirers value companies in case of acqui-hire situations, right? Where you are basically just acquiring a team, right? And how do
Yeah.
they kind of think about what do the investors get? What do the founder get? What do the employees get? Like, what have you seen?
Yeah, so I mean, there is definitely a math around this. So like, engineers are it's kind of funny to put it this way, but engineers will cost a certain amount. Business folks will be a certain amount based on salaries, et cetera. In fact, one of the companies I worked at, we got acquired by Google. It was mostly an acqui-hire. The company was really cool product. We ended up selling into basically the Chrome team, and it was a nice add-on to Chrome extension, et cetera. So the value there was based on, get rid of as sad as it sounds, but you get rid of the employees that are not really necessary. You value the employees that are there. You value the founders, obviously, because they're going to basically take over this project. It's going to be its own project within a subgroup within a larger company. And then you cash out some of these employees that are not going to be part of it, and then the ones that are coming in, you give them some the founders obviously with a bit of a golden handcuffs for a couple of years. And then some of the engineers that were instrumental in developing the technology, they get a nice initial payout with a good salary to that acquisition, stock grants, retention bonuses, etc. And then they acquire the IP, they acquire the technology, and you become part of that larger company. In this particular instance, we became part of Google. I was one of the people that exited and didn't jump in. I was a business guy, didn't really need me. So I was heading business development at the time. So it was mostly the engineers, and that's usually where the most of the value comes in.
And then on key terms, coming to you, Madhu, what are some of the key terms usually in these kind of M&A situations that founders should be aware of? And specifically, I want you to kind of underline the terms that they might not have encountered during, let's say, VC term sheets or VC fundraisings, right? Um,
Mhm.
what would be some of those things?
I'll list a few that are top of mind. One, oftentimes, that gets not looked at is non-compete, right? And the level of non-compete surprises people. They would, for example, I've seen examples where you cannot pursue anything on this topic as a new builder for the next like 3 years, which is infinity time. Empires are built and lost in 3 years these days, unfortunately, depending on the size of the empire. But non-compete can be pretty expansive. You can say you cannot build anything in e-commerce for the next 3 years, which is like, that's a huge definition, right? So that's something to think about. Specific um, payouts are also pretty severe. That if the level of interest, sorry, the interest in the company, the acquiring company is, I'm going to keep you as long as possible, even if I'm not putting you to work. I just don't want you to go work at another company. The FANG companies did this quite a bit in the last 5 years, where they hired people and kept them just so that the other company can't hire them, right? Like in AI, for example, and many engineers in many departments, not just in AI, over the last 5, 6 years, I've heard stories where they were hired to just kind of park themselves there. And I'm keeping you here so that I don't have to get you to go to another company. So be aware of what you're signing up for from a non-compete standpoint, and also from if I stayed here only 6 months, you're welcome to leave, but to make up a number, like 70% of your payout is not going to be with you if you leave. And then you'll get 50% if you stay for a year and a half. So it's really valuable to recognize this. And this is also why a good lawyer will help quite a bit with this sort of thing, right? So the two things that jump out at me are performance payouts based on performance, or payouts based on length of period you're staying at the company, and then non-competes. There's other lesser known examples where they will say, this is an actual example, company was acquired, was promised unlimited access to GPUs. This happened like less than a year ago.
Mm.
You are building amazing tech. I want your tech. You should build it within the parent company. All the GPUs you want. I won't name the name, but like, we're a company that can get as many GPUs as you want, one of the very few, and we'll definitely give it to you for this exercise because that's why we're buying you, right? 10 engineers that were part of the company joined for that reason. And the company paid maybe $2 to $3 million per engineer to come and join. And many of them immediately left completely disillusioned because they were no longer a priority. They're not getting the GPUs. They're not getting the interest within the bigger R&D. And they're like, what am I doing? So this big acquirer paid them, nobody won. Big acquired lost all the talent they paid like tens of millions for. And the engineers disillusioned because they thought they were going to work on cool stuff on the world's best supply of GPUs, but they didn't get it. So nobody won. And these guys all went off to, other some of them went to Big Fang, and some of them went to other starting their own company. And uh, one of them ended up being a senior exec at one of the large LLM players, and the acquiring company completely lost out, and they totally screwed it up. If they were actually an independent research lab slash startup, they would have been making waves right now. So that's another thing is, do you know what you're signing up for? And do you know you're going to get the money you want? Do you know you're going to get the outcome you want, even though that's what was promised at the time of signing?
And then, Hans, I think one of the things I've seen a lot is deals fall at the diligence stage.
Mm.
A lot of times because the company is not ready, the financials are messy. The CEO kind of in the initial pitch said, "Hey, we are at X million ARR," and when you actually go and do a FinDD, and you're like, "Wow, this was like whatever, like 0.4 ARR, right, or something like that," and then obviously timelines increase. So what can founders, especially as they know that okay there is going to be an exit, right, like the prep is starting to happening, maybe that 12 to 24-month period, what can they do to get the company ready, right, for, and especially for even private equity or a strategic diligence?
Right. It's that clean posture, clean slate
Yeah.
for companies to basically position themselves to
Yeah.
be easily acquirable, right? Um, I mean, it's kind of like a really important question, and it's probably one of the most boring answers, right? It's cross your T's, dot your I's, create a data room, create an acquisition checklist, make sure all of your documentations are there, make sure you don't have any outstanding, bills, make sure you didn't mess your cap table or the actual the governance is messy, or who truly owns the company. Like if I have to dig deep into something that should be so simple through the documentation that you're providing me, I don't just question the numbers, I start questioning the complete build out of this company, right? So you want to basically have your best foot forward, and that's probably the biggest thing you want to do. So, create that data room, put all the documents in there, easy to look at. When you're even thinking about an acquisition deal, have a checklist. Go down through this checklist. Be proactive about it. You're going to know what people are going to ask for during the due diligence process. Have it ready. And the best position to be in is to be in a position where you have to give more documentations that you've provided, but what you've done is you've given enough to keep them at least involved in the process. Down to like, gosh, this is also like that, like SOC 2 compliance, right? Or, is your compliance, has it been clean? Have you been, targeted for red flags down all of that is important to say, to come back and say, oh, I didn't know I needed to put that in, put it all in, right? I mean, there's nothing you're going to hide that's not going to be found out in that process. It's just going to make you look bad down the line. So keep it clean by staying honest as you can be. And maybe I'm wrong, right? Like maybe someone's like, oh, well, we were able to get past a few red flags and it was found out later, et cetera, et cetera. But, for me, I'd rather just keep it clean and see where I need to put more effort and work on, because if I don't get acquired this year, maybe I'll get acquired next year. I have the run rate. I have I had the foresight to look at the things, everything we just talked about today, in mind, where the education was preset to Madhu's point early on, that I'm already looking at this from day one, that I position myself well. And this is what multiple founders have do, and that's why they do well in their exit strategies.
Yeah, I mean, I see this so much even in the venture world, right? And a lot of times, founders are fundraising, they go out into the market with a deck, the deck is in great place, and then suddenly they start getting traction, and they start getting information requests, and then they spend the next 8 weeks putting that information request together, and then they speak to their CPA or their bookkeeper, and the revenue numbers are wrong. What they were calling
Yeah.
as whatever was actually recognized revenue was not recognized revenue. It was book revenue or contracted revenue, and definition of ARR changes, and uh, the whole thing where they actually got momentum. I mean, the hardest thing is to get an investor or an acquirer to lean in into the opportunity. So once they lean in, you've done a lot of that hard work, right? I mean, that's like you're playing on the front foot. Then you
That's
better make
exactly right.
sure that you're ready to kind of give them what they need.
Yeah, I mean, be proactive with your attorneys. Sit down, talk to your attorneys about the legality of everything that's happening within the company. Sit down with your CFO, look at all the numbers, make sure the numbers, are correct, that they look good. You do that in that process, and you'll know where you need to put more effort and energy in, and where you need to double down on attorney fees.
I was going to say fiscal kind of discipline and financial education they're both sort of under promoted in entrepreneurship. It feels like, oh, it's I'll just get a CFO, or I'll get a no, but it's your responsibility, and it's a good one to wield, good lever to wield when it's time. So as an entrepreneur, it pays to learn. One of my investors said to me when they gave me the term sheet a few years ago, they were recalling to ask me about what I thought about a clause. And I was driving and I took the call, and he is brilliant, very sharp investor, right? And he basically said, "You didn't read the terms, did you? You don't know what this implication is." And I was like, "Oh yeah, I was going to get to it. I didn't." And his point was, Madhu, you need to learn every single bullet in the document. As a proponent of you, as somebody who is going to work with you and you're going to work with me, I'm telling you, you need to know this better than I know this.
Yep.
And that was a very powerful wake-up call for me, right? It's like, oh, it's a standard document. I'm getting the check. I'm excited about the check. Yeah, I'll sign the doc. No, 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 the other way around. Be excited about knowing the documents, and then the check is okay, fine, I'm getting the check, right? So heavily
Yeah,
emphasize financial education.
it's funny, like to that point, it's like knowing down to like vendor agreements, not having any transfer restrictions. That
Mhm.
stops everything, right? Or like a customer contract, like do you understand the clauses that are in there and what implications that means after the fact? And did you have people sign NDAs and what that actually says? All these little things are going to be scrutinized in the process. Just to Madhu's point, like on the contractual standpoint, it's important to just know what's in there, and you can have your sales team run amok based on what they're planning to add just to close a deal. That's a huge no-no.
Madhu, and this is a question for me, right? As a GP, one of the core jobs is to eventually create liquidity for your LPs, right?
Mhm.
And of course, every VC knows how to source deals, pick deals, help the founders, give them customer intros, do whatever we can do to support them. But on the side of exits, and this is personally for me as well, right? I don't know what to do on a regular basis in terms of how do I help the portfolio, the founders, how do I support them in terms of eventually driving that goal. Because one, I remember back in the day when I was with a large VC firm, the managing partner used to say that the exits don't happen by themselves. And
Mhm.
then by the end of fund life, like I remember year 8 to 10, he would literally in every Monday meeting be asking each of us, what are you doing? What have you done this week, the last week, in terms of working with your portfolio to drive exits, right? And it's a very genuine question. It's not a very
Mhm.
obvious answer. So any thoughts there on that?
Yeah, actually, I, I'm glad that you asked that question, Sumitra. Not because I think you could use any of my advice. I'm sure you're doing a lot of things, and I'm happy to share my 2 cents. But it's a very valuable question for the investors in your audience, which I know there are many, right? Uh, so first thing I'll say is certainly the way I look at it, and Hans and I look at it as our roles as angel investors and kind of budding LPs ourselves, um, is it is valuable to think of your portfolio or any investor's portfolio. It's a portfolio of portfolios. And what I mean by that is if you have, let's and you particularly, I know Operator Studio takes a sort of focused, concentrated portfolio approach. So uh, as you know, as we all know, there are funds that do a couple of hundred investments and they've got like checks and everything, and that's a style, and that's a different thing that you think about, you have to work on. But a portfolio of portfolios is looking at every company as a combination of assets. There's value in looking at it holistically from a perspective of this is a company that's doing this particular job in this particular industry. But when it comes to liquidity, when it comes to evaluating opportunities for the company to find a home or graduate, so to speak, it's a collection of portfolios. that you have, right? A company has IP, people, market presence, compliance benefits, whatever. So how can you look at your every 7 or 10 or 12 companies that you have and methodically sort of intellectually dissect and register what this company is? And it'll help you when you're having conversations with secondary players, when you're having conversations with PE firms, that you are not just looking at the fact that you have 7 companies or 10 companies, you're looking at the fact that you have 47 assets, or you have strong IP representation in your portfolio in the ML ops space. You have a really good portfolio in the India-US corridor, obviously, and you have a really good representation in consumer packaged goods. So if you look at it that way, you don't just have 10 companies, you have 46 entities to try and use when it comes to liquidity brainstorming. And I don't think companies tend to think like, or investors tend to think like that, right? You put money in and hope for an exit, days are gone, long gone. So one suggestion is to look at every company methodically. The other is much lower hanging, and then, whether you use ChatGPT or ML modeling to do this, there's lots of ways to look at a company, your portfolio as a collection of portfolios or collection of assets. The other low-hanging fruit that I think many investors don't do a good job at, and I speak to this as both an investor and a founder, is frequent, consistent, meaningful conversations with your portfolio companies.
Mhm.
Right? Like understanding what their business is, what's working, what's not working. If an investor is able to cross the, oh, I should look good in front of my investor because I don't want to show them my downside. If you could cross that and inspire a sense of trust, then you'll get so much more insight into how you can be helpful to that company, and in turn identify when it's time to look for liquidity, what you can do for them. And I can say from and Hans and I both know some of these people, and certainly I can think of many that were lip service investors, and it's unfortunate. They're well-meaning investors, but their motivations didn't allow them to truly be of value to their portfolio company. It's really unfortunate, right?
Right.
Because there are assets right in front of them that they could have helped, that they just ended up not being in the right position to do so. So really thinking about your company as a collection of assets, and then building a direct trustworthy relationship with the founder or the operating team. It doesn't have to be the founder. It could be the CTO that you're building a relationship with, right? Even though the founder took money from you, you're actually building a relationship with the head of customer success. Great, no problem. You have a path into the company to knowing what's happening and being valuable to them.
Yeah. And any quick thoughts? This came into my mind again. I think very relevant for all the GPs and particularly emerging managers out there. There's this whole rise of secondary funds, right? You can sell slices of portfolios, or you can kind of bucket portfolio companies together and sell them as kind of a bucket. And
Yes,
then
yes,
we are seeing
yes.
very, very interesting kind of models in the market today. Any views on that?
Yeah, absolutely. I'm glad you brought that up. We didn't touch on the buy side. We
Yeah.
only talked about how do you optimize your sell side. On the buy side, in fact, Hans and I are actively involved in helping at least one venture fund identify buyers for a package of their positions. And so lots of options there, but just to keep it sort of relatively brief, uh, family offices are starting to seek positions in GP positions. So they don't want to own the company directly. They want to just be a part of the GP's position so that they have a passive ownership in vetted opportunity. So, and generally speaking, private markets are seeing a huge expansion in focus, money, technology, et cetera. So family offices are a really good source, single family office, multifamily offices, et cetera. And then boutique secondary firms that are starting up are another opportunity, right? Many of them are starting to look at venture portfolios, given the value being more attractive than it was 5 years ago. So actively seeking out those folks in addition to family offices. This is where also a GP connecting with a good banker is going to be really valuable, right? I was talking to somebody at Morgan Stanley, and they have a huge private wealth practice where if the company is at a certain portfolio size, then they absolutely directly can email blast 250 HNIs, high net worth individuals, to see if they'd be interested in a position. So relationship building on the buy side is critical, whether it's a family office, high net worth investor, fund of funds is another path. And increasingly, many of them aren't aware of some of these portfolio companies, or aren't aware of emerging manager, emerging funds, but they would love to consider it once they get a sense of the financials. So it's a matter of you making yourself known as an investor. That would pay off, because the focus on sort of smaller sub $100 million funds and what they have to offer is relatively new. And so there's a lot of opportunity for brand building that isn't very aware, that many investors aren't very aware of, because you usually write it off as, I'm not big enough. But no, actually, there's a huge set of opportunities. So some of the players I just mentioned, worth considering. Hans and I are in conversation with a group of family offices that is looking to expand their presence in the US. That's a good example, right? We're also talking to some brick and mortar family offices that are want to dip their toes into tech. So tons of opportunities out there for secondaries, especially because many of them are now thinking now is a great time to go shopping.
You know, things are changing, and they are. I mean, family offices tend to go into, real estate and stock market, but they're slowly, the younger generation within these family offices are looking at tech investments. And
This is actually a great segue to my final question, which is, how should founders look at working with advisory firms, investment bankers, boutique advisors? I know you guys are doing great work at HKMC, right? So even in that context, right, when does the role of an advisor come in the life cycle of a company? When does it become relevant? Hans, any thoughts there?
Yeah, I mean, there are like rules of thumb here that, like, below 5 million, you don't really need an investment banker. It's a founder sale. Uh, like 5 to 10 or so, you get advisors, because now you have, and this is an ARR, right? So you have a good amount of money coming in. Still might not be big enough for the big players, or investment bankers, whether they're boutique or larger. 10 million plus ARR, yeah, definitely jump in with a banker there, and investment banker, because the idea is to increase your leverage, right? And then so the whole point is they're going to know how to create a higher level of sophistication. And you want to rely on their network as well. The main goal there is to make sure that it's not just banker led. Like, you don't just give it to the investment banker, and you need to be with them, and you need to make sure that you're aware of every step of the way, of every single thing that's happening. So this is not a handoff. This is a come work with me and make sure you're part of the deal. Choose the right one, right? You want to make sure that you're choosing people that, one, you can trust, that the incentives are correct. Last thing you want is just to have a banker wanting to close the deal because all they're going to get paid no matter what, and it's not necessarily the best deal for you. So be cognizant, aware of that, and your overall positioning and your overall stage and deal type. Also is the reason why you're going to use an investment banker, and what kind of investment banker. So if you're kind of in like a Series B, we talked about the ones in the stages like 10 million ARR plus. But let's say you're in the 5 to 50 million range, in Series B round. It's still boutique, it's still small. You're in the 50 to 200 million. You're kind of in the growth equity specialist like Catalyst, AGC, et cetera. And of course, 100 billion plus, you're in the big players like Morgan Stanley, JP Morgan, Goldman Sachs, et cetera. And because it's such an important part of the life cycle of your company, again, I always say, like, just be aware of the terms, be aware of, who you're bringing in. This is kind of like, this is your last stage after putting so much effort, energy, time into your company. You want to make sure that it's done right, right? You don't want to overpay fees. There's no misleading incentives, and there's no full control from the banker side in terms of the process. So as long as you are able to do that, and where you are in terms of what I've outlined in terms of where you are in your company, advisors are always going to be great. In the interim, investment bankers are great when you are making a substantial amount of impact within your market. Use them to increase your leverage, and make sure you choose the right one.
No, absolutely. And I think the word I would like to highlight here is trust. I think,
Yeah.
that's the bottom line. I think you want to almost work with people where you could open up the kimono at every level, right? From the
That's
business to your own personal insecurities. And I've seen like the best advisors, lawyers, bankers, they actually tend to become the most closest confidants of CEOs and of founders.
Yeah, no, totally. I mean, and remember, this is a relationship that if you are a serial entrepreneur, you're going to be dealing with the same folks again and again, right? And the more trust you build and the stronger like positive intention you have with these relationships, the easier it's going to be in your second, third, fourth round. And that's why we say, oh, this is a 5-time, repeat entrepreneur. It's like, holy crap, why would you do that? Well, it's not going to be the same as your first time. It shouldn't be if you've done things right. It becomes, in essence, easier because the relationships are there. So you're no longer building the relationships. You've been maintaining them for a while. You're just really good at executing, operating, and having the right idea at the right time, right? That becomes why you're unique compared to someone else. But from a relationship standpoint, yeah, you beat yourself up the first time around, so you don't have to do it the second, third, fourth time around.
One last thing to call out, the sort of the pitfalls here also is important to have a clear sense of expectations for the advisor, where are you bringing them on for guidance on, let's say sales, on product, on financial mechanics, on culture, like you talked about, insecurities and the founder journey and all of that sort of thing. So be very clear on what the expectations are, and then it just makes for a better relationship. And then there's tons of guidance online, like Peter Walker put out from Carta, put out what are advisors getting in terms of equity these days, et cetera, et cetera. Be deliberate in your relationships, right?
Yeah.
Don't get an advisor because this person is cool and they were employee number 14 at Snowflake. That's great, but what are they doing for you, and what are you offering to them? Otherwise, the relationships will tend to get tedious if you weren't very deliberate in why you're pursuing them.
So, this has been an amazing conversation. I think to kind of close out, I would say that every founder obviously starts a company with the objective that the company should last for 100 years. Every investor invests in a company thinking that they're going to make 100x on the company. But then, of course, there are realities of the business, right? And I think that's why I feel that it's very important to have a conversation around exits, various kinds of exits, various kinds of models. It is a reality of business, and really important to share learnings around it. So this was an amazing discussion, and thank you so much for sharing your really lived experiences and all the expertise that you have gathered over what combined 40 years.
Yeah, prepare to lose your hair in the process, or white beards along the way. What I wanted to say was, in the end of the day, when you're really thinking about it, and this is, the truly heartfelt commentary around seeing people go through it, me going through it, friends going through it. You're never alone in the process. It's going to be tough, and think of yourself also as a competitive advantage. There's only you, a unique you. You approach things in a unique way. You think about things in a unique way. Really, truly believe that you are a competitive advantage in the process of building your company, growing your company, scaling your company, selling your company. And in the end of the day, this is not your first and only, it could be your first, it won't be your only rodeo. Don't define yourself so complete by this one instance in time. This is always going to be a learning experience. It's always going to be a growth experience. Now, you either succeed or you learn. And this whole concept of there's no failure in Silicon Valley, I get it, but I'm not utilizing, shameful losses here. It's really a learning experience. Learn from it, grow from it. Don't let it harden your heart. And there are so many people that want to see you succeed, no matter what you feel. And we hope to continue to help entrepreneurs who really think that way on all fronts, or even PE firms who are calling us and saying, hey, here's our buy side mandate or whatever, sell side mandate. Can you help us out? The relationships are truly the most important, and we want to work with the best people and try to be one of those best people out there. There are a lot of bad people out there. but when you start finding the good people, hold on to them and continue to build through that relationship.
Great, very well said. Thank you, Hans and Madhu, for joining me.
Thank you for having us, Mitra. Appreciate
Thank you
it.
for having us. What an exciting conversation. So, Mitra, thank you.